Michael Burry, famous for predicting the 2008 financial crisis, has sold over $70 million of his U.S. stock holdings. This video explores his latest investment strategy, focusing on Chinese tech giants and the implications of his bold decisions. Before we dive in, if you've ever thought about investing, the first link in the description takes you to Interactive Brokers, the platform I use. Michael Burry has made headlines again. His recent decisions have raised eyebrows and sparked discussions among investors. Selling off a large portion of his U.S. stock holdings is not something he takes lightly. This shift in strategy reflects his views on the current market conditions. Burry is known for his analytical approach. He carefully assesses the risks and potential rewards of his investments. His latest moves indicate a strong belief that U.S. stocks are overvalued. This belief drives his decision to pivot towards Chinese tech companies. What are the key factors influencing U.S. market valuations? Valuations in the U.S. market have reached alarming levels. The S&P 500's price-to-earnings ratio is a key indicator. Currently, it suggests that stocks are expensive. This scenario is reminiscent of the late 1990s, just before the dot-com bubble burst. High valuations can signal trouble ahead. Investors often overlook these signs when the market is booming. However, Burry seems to be taking a different approach. He understands that high valuations can lead to painful losses. Many investors are caught in a cycle of optimism. They believe that prices will continue to rise. Burry, however, is wary of this mindset. He prefers to act when he believes the risk-reward ratio is unfavorable. How does market concentration affect the economy? Market concentration is another issue facing the U.S. stock market. A small number of companies dominate the index. Currently, 4 companies account for a significant portion of the S&P 500's performance. This concentration creates a precarious situation. When a few stocks hold up the market, it becomes vulnerable. If one of these stocks falters, the entire market can suffer. Burry recognizes this risk. He is cautious about investing in a market driven by so few companies. The current level of concentration is one of the highest in decades. This trend raises concerns about market stability. Investors should consider diversifying their portfolios to mitigate this risk. Why Chinese stocks are attractive? In contrast, Chinese stocks present a different picture. They are currently undervalued compared to their U.S. counterparts. The price-to-earnings ratio for Chinese stocks is significantly lower. This presents an enticing opportunity for investors like Burry. Many investors remain pessimistic about China. This negativity has created a buying opportunity. Burry sees potential where others see risk. His investments in Chinese tech giants reflect this belief. Chinese stocks may offer high reward potential. If the market rebounds, these companies could see substantial growth. Burry's strategy hinges on this possibility. The Chinese government has introduced various stimulus measures. These initiatives aim to boost economic growth. Recent actions include interest rate cuts and increased spending on infrastructure. Such measures are designed to stimulate consumer confidence. As disposable income rises, spending may increase. This can benefit companies like Alibaba and JD. Burry appears to be banking on this potential recovery. Investors are watching these developments closely. The effectiveness of the stimulus will play a crucial role. Burry's investments may hinge on how well these measures stimulate the economy. If you're truly curious about investing, I've found Interactive Brokers platform helpful in my own journey. You can find it linked below. Go ahead and check it out. Why is Michael Burry shifting his investments to Chinese tech companies? Michael Burry has made a significant shift in his investment strategy. He is moving away from U.S. stocks and heavily investing in Chinese tech companies. This pivot is notable, especially given the current economic climate in China. Burry's decision to invest in Chinese firms like Alibaba, JD, and Burry reflects his belief in their potential. He views these companies as undervalued compared to their U.S. counterparts. The price-to-earnings ratios are significantly lower, suggesting room for growth. This shift is not just about valuations. It is also about the opportunity presented by the current state of the Chinese economy. Burry is betting on a recovery in consumer spending and overall economic growth. Analyzing the current state of China's economy. Despite slowing growth, low consumer confidence, and a struggling real estate sector, the Chinese government is implementing stimulus measures to bolster the economy. Burry is closely monitoring these developments. He believes that if the government's actions are effective, the economy could rebound. This potential recovery could lead to significant growth for companies in which he has invested. Consumer confidence plays a crucial role in economic recovery. When confidence is low, people tend to save rather than spend. This behavior can hinder economic growth. Recent data shows that consumer confidence in China has been weak. Many people are cautious about their financial futures. This has resulted in decreased spending, which directly impacts businesses. However, Burry sees a potential turnaround. If the government's stimulus measures succeed, consumer confidence could rise. Increased spending would benefit companies like Alibaba and JD, which are poised for growth. Burry is not just blindly investing in Chinese stocks. He is using hedging strategies to protect his investments. His use of put options serves as a safety net against potential losses. Put options allow him to ensure his positions. If the stocks decline, the value of the put options increases. This strategy provides a level of security while he maintains his investments. Burry's hedging approach demonstrates his awareness of market risks. He understands that while the potential for growth exists, the risks are also significant. His strategies reflect a careful balance between optimism and caution. How do you balance risk and reward in investments? Investing is all about balancing risk and reward. Basically, the bigger the potential payoff, the riskier the investment usually is. You've got to figure out how much risk you're comfortable with to get the return you're hoping for. Risk means you might lose some or even all of your money. Things like market swings, the economy, what's going on with a specific company, or even stuff happening around the world can all affect how risky an investment is. You can get a sense of the risk by looking at how an investment has done in the past, checking out a company's financials, and seeing what experts are saying. Reward is what you hope to gain. Maybe the price of your investment goes up, or you get dividends, interest, or rent. To figure out the potential reward, you might look at how it's performed before, what's happening in that industry, and if the company seems likely to grow. Finding the right balance is different for everyone. It depends on your age, what you're saving for, how long you plan to invest, and how much risk you can stomach. Younger folks with more time might be okay with riskier stuff to try and get bigger returns, while people closer to retirement might want to play it safer. One good way to manage risk is to diversify. Don't put all your eggs in one basket. Spread your money around in different types of investments, different industries, and even different parts of the world. If all this sounds confusing, talking to a financial advisor can be a big help. They can look at your situation, help you come up with a plan, and give you advice along the way. And remember, the investment world is always changing, so it's important to stay up to date on what's happening in the markets, the economy, and any new rules. Balancing risk and reward is something you'll be doing throughout your investing journey. It takes thought, research, and being able to adapt. By understanding the connection between risk and reward, knowing your own situation, and using smart strategies like diversification, you can increase your chances of reaching your financial goals while keeping risk in check. For those seeking to take control of their financial future, platforms like Interactive Brokers can provide access to a wide range of investment opportunities, allowing individuals to participate in the market and potentially build wealth over time. Click the first link in the description to learn more.